If I can get the screen to advance, there we go. And we'll talk about the chart of accounts, what is an account. We'll talk about journalizing transactions. We'll post those transactions. We'll talk about what an unadjusted trial balance is, and we'll talk about horizontal and financial statement analysis. So the first thing we'll talk about is just what an account is. Accounting systems are designed to show increases and decreases to, it says, the equation elements. And remember, that's just the accounting equation. And we spent time in Chapter 1 talking about how several types of transactions affected the accounting equation, knowing that it was always in balance. And so what we're going to do is take those elements of the accounting equation and break them out into more detail into something called an account. And we kind of actually did that in Chapter 1 without really telling you that's what we were doing, because this just came from Chapter 1, and these are the transactions that our new company called Net Solutions did for Chapter 1. And you can see that as we went through the several transactions, we just kind of focused on how it made the accounting equation still in balance before and after. But if you just think of the column headings here, cash, supplies, land and assets, payables for liabilities, and then equity is made up of everything else: capital, stock, dividends, revenues called fees earned, and various expense accounts. Each one of those column headings is truly an account. Okay, so we'll spend some time today talking about accounts. And so the T account is called the T account just because it makes the letter T. Pretty simple. You've got a horizontal line, got a vertical line, we make the letter T. The account title is always at the top, and that's just what the name of the account is. So all those column headings on the previous screen, each one of those can be a separate T account. The left side of a T account is always the debit side, always and forever, that never changes. And the right side is always the credit side, again, always and forever, that never changes. So, I keep saying every chapter here, there's going to be a few things you just have to remember. You have to memorize the accounting equation. You have to memorize this T account right here. So debit's left, credit's right, title's at the top. Make a note of that. That will help you forever and ever in this class. And so here's just an example of a T account, and this is the posting of all the transactions that went through our company in the month of November when the company started. We had the initial deposit of cash of $25,000 from the owner account into the business account, so that debit of cash at 25 right here, and then so another debit and various credits. And so the debit side's left, credit side's right, and we have more debits than credits by $5,900, so that's our balance. So whenever you see a horizontal line like this down here, that basically means we're going to stop and subtotal the account, and then we total it up, and then we don't add each side down. Instead, we just figure out which side has the most, the highest value, and that's the side that we only put a number in. So an account total only has an account on either the debit or the credit side, but not both. That's a key mistake I see people make when they first start the class. So a chart of accounts then is just simply a grouping of ledger accounts organized a certain way. Okay, so a grouping of accounts is called a ledger, and then we organize the accounts in a ledger through what we call a chart of accounts. And so, the assets category, we break out that chart of accounts by how the accounts fit into the accounting equation. So the assets category has the various asset accounts. Several of these we looked at for Net Solutions: cash, supplies, receivables. They had some land, some other examples: building, vehicles, equipment. The list goes on. We also have assets called intangible assets, and those are assets that don't have a physical substance, so you can't see them, touch them. They typically are more evidenced by a contractual arrangement or something like that. So a copyright, a trademark, obviously those are things that you can file and get registered and protected with the government, but those things are more intangible. They're just really evidenced by a piece of paper. But of course they have value. Just think of any famous copyrights or trademarks. If you see the swoosh, you think Nike. Obviously, that's a trademark that's been protected. Only Nike can use that unless somebody agrees to license it or something like that. Your various liabilities, you can see here, anytime you see the word payable, it's safe to assume that's a liability. Okay, so accounts payable, notes payable, wages payable, interest payable, the list goes on. There's several examples of payables that we'll go through eventually in the class. Stockholders' equity includes basically the owner's interest in the business. And so basically what the owner's right is to all the assets after liabilities have been deducted or liabilities have been paid. Okay, so the capital stock account and the retained earnings accounts together make up equity. And then a dividend is just basically anything that's been distributed back to stockholders, or in this, if it's just an owner, that owner would take a dividend out of the business. Revenues, then, there's various kinds of revenues. We mentioned a few in Chapter 1. But typically, it's the increasing of equity by selling goods and services to customers. So fees earned if we're providing services, sales revenue if we're selling physical goods. You can earn a commission revenue, rent revenue, interest revenue. Again, there's several, just like there is with everything else. There's several examples. And expenses then are basically either assets that are consumed, like prepaid assets or supplies, or just simply bills we have to pay as a result of generating revenues. So wages, rent, miscellaneous, advertising, insurance, taxes, the list goes on. Okay, so basically just think whenever we earn a revenue, we also incur expenses. And of course, we need to record both of those. So here's an example of a chart of accounts. You can see it's organized by the various categories of the accounting equation. On the left-hand side, you see assets, liabilities, and equity. On the right-hand side, you see kind of the subsets of equity, revenues, and expenses, because remember, revenues make equity go up and expenses make equity go down. And so they're organized by a number. And so you see an asset starts out with 1, liability with a 2, equity with a 3, revenue with a 4, and expenses with a 5. That's a pretty common setup for a chart of accounts. Very, very common. I've worked in companies where the chart of accounts were 15, 20 characters long, but that first digit always was the identifier of asset, liability, equity, and so on. And it was always this 1, 2, 3, 4, 5 category, just like we see here. Okay, so next we'll talk about double entry accounting. All businesses use the double entry accounting system. And so basically the system is based on the accounting equation. It requires that every transaction has at least 2 accounts. It could have more than 2, that's okay, but the minimum is 2. And total debits of a transaction must equal total credits. If you're using a computerized general ledger system, I have not used one yet that lets you do an unbalanced entry. You have to, an administrator can do it if they really have to for some reason, but typically you will never do an unbalanced entry in a transaction in a accounting system. So now we're going to kind of be doing this more, quote unquote paper based, even though it's really all online. But we're kind of replicating a manual system. And so you have to be very aware that when you make a journal entry, that the debits and credits are the same number. They balance down to the same thing. There are now rules of debit and credit, and I hate to keep saying there's things you just have to memorize in this class, but here's something you just have to memorize. And what we'll discover is really about the first 4 chapters of this class are what I call the foundational chapters. And what that means is these are the chapters where we're kind of getting that base knowledge of accounting in our brains, of how things work. And then kind of once we've got that down, we kind of just keep using that as we get through the rest of the chapters during the semester. So you'll discover that you really want to focus on learning some of these base things, because the quicker you do, the better you do, the better you'll perform in the class, which is a goal that you should set for yourself. Obviously, I would love to see everybody do really well. And so memorizing the accounting equation and the rules of debit and credit, how a T accounts works, the debits left, credits right, those are just things that once they become base knowledge in your head, just gets easier in the class. Instead of having to always sit back and think, how does this work? How does this fit in? If it just becomes just basic information, it goes so much faster. You'll do so much better. So I just hate to say it, but if you can memorize this, you're just going to be better off. Okay, so here are the rules of debits and credit for the balance sheet accounts. Okay, so we've got the accounting equation here, assets equals liabilities plus equity. Notice that on the asset side, a debit makes assets go up and a credit makes them go down. On the liability side, it's the opposite though, okay, because that equal sign is kind of your dividing line more or less. If you're thinking of algebra, if anybody can remember an algebra class, kind of works the same way. If you've got plus and minuses on one side, they have to be the opposite on the other side of the equation. So I guess the trick I'm trying to help you to learn this is, if you can just remember that for assets, debits are pluses and credits are minuses, you can just think automatically it's the opposite for liabilities and equity. Okay, so that might help you just learn that. But that's just one little trick that I've thought of over the years of doing this. So here is then the income statement accounts, and remember that revenues make stockholders' equity go up and expenses make stockholders' equity go down. So let me go back a screen here and just show you that for equity over here, look at this one to the right, debits are decreases and credits are pluses. Okay, so if I have a revenue account and that makes equity go up, then look at that, revenues are the same, credit side. Just like the equity account, credits are pluses and debits are minuses. And so for revenues, if credits are pluses, that means the opposite has to be true for expenses, where credits are decreases and debits are pluses. Okay, and just also note that no matter what T account we looked at, debits are always left and credits are always right. It's just which side is the plus side, which side is the minus side. Just depends on how that account fits into the accounting equation. Dividends, remember that dividends reduce equity. It's the owner taking money out of the business, and so therefore the credit side has to be a decrease, opposite of revenues, opposite of the equity account itself, and debits are increases because we're taking cash out, which means you're taking equity out of the business. And so all accounts then have what we call a normal balance, and you would expect that account to typically have at the end of an accounting period either a debit or a credit balance, and that would be its normal balance. Okay, so here then in green are the normal balances for all of our accounts. So basically what this is the full entire accounting equation with all the various debits and credits, and the basically which side are the pluses and which are the minuses. And whenever you see the shaded green, that basically means that's the normal balance, which is always the plus side. Okay, we expect that account to typically have a debit balance if it's an asset, to typically have a credit balance if it's a liability, and so on. And this just kind of summarizes it also, what the normal balances are. So again, just one of those things that the quicker you get that into your base knowledge about accounting, the better off you'll do in this class. It's just that simple. So if you can just make notes, look through this, you're going to be just better off. So of course there's always transactions to think about. So let's go back and think about those transactions we looked at back in Chapter 1, where we just kind of focused on how each transaction impacts the accounting equation. But now we'll take these same transactions and actually break them down into debits and credits and create what we call a journal entry. And so remember that journal entries always have at least 2 accounts. Okay, and so there's a few steps to follow here. There's 5 steps we have to think about when it comes to recording a journal entry. Step 1, pretty simple, is the date. Okay, now this journal here, basically just think or imagine you had an 8.5 by 10 piece of ruled paper in front of you. And that's essentially what a journal is. You start at the top and you just work your way down to the bottom of the page. You get done with a page, you start a new page. So you have journal page 1, that would be the very start of the business on November 1st when this business is starting. You just keep going down the page, starting a new page every time you fill one out. Okay, and so that's basically what we're doing, only we're doing it electronically. And so you can see here for our description, we're going to debit cash, and credit capital stock. That's steps 2 and 3. So notice that the account we credit, capital stock, we indent a little bit to the right. Okay, that just kind of signals as we look at the journal that anything indented is a credit, anything all the way to the left is a debit. And then we always have an explanation. We're trying to leave ourselves some breadcrumbs. We're trying to leave ourselves some clues. If we find an error in our accounting, we have to go back and fix it. So if I leave myself some clues, I'm giving myself the ability to go backwards, look at transactions, and understand why we did that transaction. So that's what the description's about. Part of step 2 was the debit dollar amount, and step 3 was the credit dollar amount. And notice that my debits and credits equal, we're the same. And step 5 is the posting. Okay, and again, I'm leaving myself some clues when I do the posting. And so once I do a journal entry, I have to post it from the journal to the ledger. Remember that the ledger is a grouping of accounts, and the T accounts represent an account in my ledger. And so I've got assets here with cash, debit at $25,000 because cash is going up. I debit cash to make it go up, and I credit capital stock because it's his owner investment, and so that goes up and I give it a credit. And so I've got total debits, total credits are the same, and my transaction balances. So the steps are right here. Step 1, basically the date. Step 2, the debit account in dollar amount. Step 3, indent a little bit to the right below the debit. And then it's the credit account in dollar amount. So we typically in a journal entry do our debits first and our credits second. So that's typically when you look at a journal entry, that's what you'll notice. Step 4 of that description, and then step 5 is the post ref, which stands for posting reference. We leave it blank until we go back and we do the posting, and then we just kind of make a note that we've done the posting. Again, we're leaving ourselves some clues if we ever have to go back and trace through what we've done to look for mistakes. Unfortunately, it's really easy to make mistakes in accounting. You'll discover that on your own. Okay, so I told you what a journal was, and we're going to then basically record transactions as they happen. We have some evidence that a transaction happened, typically some source document, if it's a receipt, an invoice, a bank stub, a bank statement. There's all kinds of potential a bill that comes in the mail that we're going to pay. There's all kinds of evidences of transactions, all kinds of source documents we'll look at, and then once we identify that, we go ahead and we do the journal entry. And so the entry in the journal is called a journal entry. So we've got a journal, we record transactions in the journal, and then we have several journal entries on a page of the journal. Okay, so let's do another transaction. These are the same transactions we did for Chapter 1. Net Solutions will buy some land. Okay, they're going to pay $20,000 to buy some land, and then maybe potentially in the future put a building there. And so again, the date, the debit account, which is land, $20,000, and the credit account, which is also an asset account. So both are assets, but one goes up and one goes down. Remember that cash being an asset, whenever I decrease cash, I give it a credit. If I'm increasing cash, I give it a debit. Same thing for land. So I'm increasing my land account, but I'm decreasing my cash account. Okay, so for the accounting equation, liabilities and equity didn't change, but the components of my assets changed. I have more of one asset, but less of another, and everything still balances. Okay. On November 10th, the Net Solutions purchased supplies on account for $1,350, and whenever you see the words on account, that means we take possession now and we'll pay for it in the future. And so you can see here I'm going to debit supplies, credit accounts payable. I've got my journal entry down at the bottom. My journal entry at the top and my posting down here. So I've got more of one asset of supplies and more liability. So the accounting equation, of course, is still in balance. And then we can just go through and do the same thing for all the various different transactions that happened. You can look at those, PowerPoints out there, you can look at those on your own, but you can just see what the various transactions. So I'm not going to go through every single one of these. You can easily look at these on your own and get a feel for how they work. So I'll just scroll through here just so you can see that all the same transactions that we looked at in Chapter 1 we're also looking at here in Chapter 2. Okay, so now we've got a whole bunch of journal entries, right? And we've done some posting to the T accounts. So what do we do next? Okay, and so that posting is that process of taking the debits and credits from the journal entries and transferring them to the ledger accounts, right, and filling out the T accounts. And so now we're getting into December for net solutions. So now it's a new journal entry, and they're going to buy a insurance policy. It says for liability, theft, and fire for a 1-year period, and they're going to pay $2,400 for that insurance policy. Okay, and because it's an asset that they're paying for in advance, basically it's an expense they're paying for in advance. Let me say that better. And that expense, whenever you prepay an expense, is an asset. So we're going to have this account called prepaid insurance on December 1st. So we'll debit that account, which is an asset, and we'll credit cash, which is also an asset. So one asset goes up, one goes down. And you can see then that the accounting equation obviously still isn't balanced because one asset went up and one went down. Okay. And so, of course, we're going to post that from the journal to the ledger. Now, what they're showing us here is not a T account, but what they call a 4-column account. It works just like a T account, but typically if you were going to do a real paper-based accounting system, it would look just like this. That you would have, literally this 3-ring binder with, a section for your journals and a section for all of your different accounts. And it would basically be a page for every account. It would be these, what they kind of call 4 columns down here, because we start out with the balance, and then you can see we've got a debit and credit, and then we have a running total over here. So like for cash, for example, because there's several transactions, we had the initial deposit of $25,000, and then on November 30th we had a credit which would subtract out. We had December 1st another credit. So all you're really doing is taking whatever the balance is, so 5,900 minus 2,400 equals 3,500. Just keeping a running tally of what you have. Okay, so you can just see we transfer the 2,400 right there. And you can see how that works. So notice that what they did here finally is they filled in the journal the post-ref column. And so you're basically saying, I don't write in that post-ref, that post-reference, posting reference is what they call that. I don't write that in until I actually do the posting. So prepaid insurance is account 15, cash is account 11, and that's what I wrote in here. Okay, so again, I'm leaving myself breadcrumbs or clues to say if I have to go back and find an error that I made, I want to be able to double check, if I go and double check this posting, that it truly is in account 15 and account 11, and it truly was a debit of 2,400 and a credit of 2,400. Okay, so I'm just leaving myself clues about where I put this number at. Okay, and so we can do the same thing then for December transactions for net solutions. They're going to pay their rent for the month of December. And so you can see we're going to debit rent expense, credit cash. You can see how that works. They're going to, it says rent the land that was purchased. They've received an offer, so maybe they're going to rent out that land that they just bought. The retailer will put a parking lot there for its employees and customers. Net Solutions agreed to rent the land for 3 months with rent payable in advance. And so they received $360 for 3 months of rent, beginning December 1st. And of course then what they have is called unearned revenue. Okay, so basically they're going to earn rent revenue, but they received it all up front, and they don't really get to earn rent revenue until the time has passed that they've received the rent for. And so they received the cash on December 1st, but it's good for 3 months. And so they debit the cash account. They can definitely put the money in the bank, but then they have a liability called unearned rent. So earlier I said a liability is always signified by the word payable, but you can also have a liability when you see the word unearned, that also means liability. On December 4th, they purchased office equipment on account from Executive Supply of $1,800. So on account again means we're taking possession of the asset now, but we'll pay for it later. So you can see we're going to debit office equipment, which is an asset, and credit account payable, which is a liability. They're going to buy some advertising. So you would debit advertising expense and credit cash. They're going to pay creditors $400, basically just pay some of our bills. We've got some payables, and we want to make a payment on what we owe people. And so we'll debit accounts payable, reducing the liability, and we'll credit cash, reducing the asset. Remember, we pay cash, we give it a credit. They're going to pay a receptionist and a part-time assistant $950 for 2 weeks of wages. And so we would debit wage expense and credit cash. We're going to receive fees earned from the first half of December. Basically, we've been providing services to our customers, and we're going to receive some cash for those fees. And so we'll debit cash, we'll credit revenue, fees earned. You can see that fees earned on account totaled $1,750 for the first half of December. So what happened is we did some work for some clients who agreed to pay us later. Okay, so we, as long as that's the agreement, we agree that we'll do the work, you pay us later. We can do the work, bill the customer, and then give them a time frame to pay us back. And so again, that on account means I'm not getting paid now, I'm going to get paid in the future. And so I have an account receivable, which is an asset, which basically says somebody owes me $1,750. And I still credit the fees earned account. I paid $900 to Executive Supply because remember I owed them $1,800, so I'm making a partial payment. So I'll debit account payable, I'll credit cash to pay off a part of that bill. I'm going to receive $650 from customers in payment on their accounts. So those customers that owe me money I'm going to receive partial payment. And so I'll debit cash and I'll credit account receivable. So one asset goes up, cash, but another asset goes down, account receivable. And then I'm going to buy some supplies. It says paid, so the word paid means that cash is involved, so we'll debit cash, one asset goes up, and we'll debit supplies, let me say that right, and credit cash, so one asset goes up and one goes down. And then we're going to pay our receptionist for 2 weeks' wages and our part-time assistant. This time it's a little bit more than last time, $1,200. And so again, we'll debit wage expense and we'll credit cash. We'll then pay our telephone bill for the month. We'll debit expense and we'll credit cash. One asset goes up. Asset goes down, but expenses go up. And so basically that expenses going up makes equity go down. And so because of that, the accounting equation is still in balance. We'll pay $225 for an electric bill. And so you can see we'll debit expense, credit cash again. Debit expense, credit cash. We'll receive some fees for the second half of December, so we'll deposit those. We'll debit cash and credit fees earned. We will earn on account a total of $1,120 for the second half of December. So again, we did more work for customers on account where they agreed to pay us in the future. So we'll debit account receivable, credit fees earned. We'll pay a dividend to the owner. So we'll debit the dividend account and we'll credit cash. Okay, and so here then is the ledger for Net Solutions, and you can see the left column here is your general journal for November and December. A lot more transactions happen in December. Then the right hand side we just have some of the accounts and some of the postings from the journal to the ledger. Okay. Notice the post ref here, the ledger is, that says 1s and 2s and 3s and 4s, but that should really be the account numbers that are over here. Well, see that. Well, I'm sorry, that's cash. I was thinking that's a general journal. That's the cash account. So the posting reference, that's correct, is general journal page 1. Okay, so that's the cash account, land account, office equipment account, accounts payable, and you can just see the posting reference here just means this 25,000 came from general journal page 1, page 2, page 3, page 4, and so on. Then we've got the other accounts that are here that we went through. Okay. So next is what we call the trial balance. And the trial balance is just like it sounds, trial balance. We're checking to see if the accounting equation is in balance. So it's kind of a trial. It's a check and see, did we do this all correctly? Okay. It's really easy to make mistakes when you post from the journal to the ledger. You can do bad math. You can write in the wrong account number, the wrong dollar amount. All kinds of mistakes to be made, unfortunately. And the trial balance here, then, it's a listing of all the accounts in the order of how they fit into the accounting equation, with assets first, then liabilities, then equity accounts, then revenues, then expenses. They're in the same order as the accounting equation. Every account has either a debit or a credit balance. An account cannot have a debit and a credit balance. It's one or the other. And we subtotal both, and as long as they both have the same number, we balance, which is a very good feeling. Okay, so we balance. Now, unfortunately, though, it's easy to make mistakes, as I keep mentioning, and I keep mentioning that because it's going to happen. And so if a transposition error is, let's say I was supposed to write down 542, but instead I wrote 452 or 524. A slide error is dropping a digit or putting in a decimal. So 542 becomes 54.2, or 9750 becomes 975. That's a slide error. Or sometimes you just drop a digit. Instead of typing in 9750, just type in 97. So some errors don't affect the trial. So those errors would affect the trial balance, a slide or a transposition error. If you accidentally posted to the wrong account, though, that would not show up on the trial balance necessarily. It would still balance. But sometimes what you have to do if you find an error is you have to make a correcting entry to fix it. So it's not unusual to make a correcting error. Posting error is basically we're supposed to debit the office equipment account, but instead we debited supplies. So the journal was right. It's just that when we went to post it, we posted to the wrong account. Okay, so of course if I realize that, I can make an entry to fix it, and I can credit supplies and take the money out of the supplies and debit equipment and move it to equipment. So it's not unusual to have to make a correcting entry. It's not unusual at all. Okay, and because we talk about numbers so much in accounting, we have to also talk about analyzing those numbers, right? That kind of makes sense. And so in a horizontal analysis, the amount of each item on a current financial statement is compared with the same number from a previous statement. So we're comparing several periods from left to right, horizontal. When two statements are compared, the earlier statement's used as the base for the change, for the percent of change. And so we'll show you what that looks like here. And so horizontal analysis is basically I'm saying, how did my numbers change from 2013 to 2014? And you can see that they go up, right? So fees earned went up, so it's an increase. And that percent is 37.5 divided by the base year of 150 gives me my percent increase. And you can see they just kind of gave us a slice of numbers down here for rent expense. You can see that the change was 3,000. It went up by 3,000. And so 3,000 divided by the base year is 25%. So just think of it as current year. This column right here is current year minus prior year. And then the change divided by the prior year is your percent. Okay, so the change of 3,000 divided by the prior year number of 12,000 is your percent change. So that's a very simple horizontal analysis that you can do.